Let's get into your market news now. Chinese markets bucked yesterday's downward turn, making substantial gains at the close. This as China's security regulator announced a number of measures to stem the bleeding markets. Reports that there was a planned meeting between President Xi Jinping and financial regulators also boosted market confidence. However, more broadly, Asian markets were on a downer as the realization dawned that the interest rate cutting cycle isn't on the horizon anytime soon. This assumption was also supported by positive economic data coming out of the United States, which will make it more difficult for the US Fed to consider cutting rates in the foreseeable future. Reversing gains observed yesterday, the Nikkei share index ended the session down 0.5%. Meanwhile, the Hang Seng index jumped dramatically today, up just over 4%, while the Shanghai Composite Index gained 3.23%. Over in the United States, Wall Street's main indexes lost ground on Monday after Federal Reserve Chair Jerome Powell pushed back firmly against speculation that rate cuts would be imminent, while investors assessed a mixed bag of U.S. earnings reports. The S&P 500 lost 0.32%, the Nasdaq Composite was down by 0.2%, and the Dow Jones Industrial Average fell by 0.71%. The JSE is in positive territory today. The all-share index has added 0.3% to 74,322 index points. The Industrial 25 index is 0.9% higher, financials gaining 0.6%. Markets over in Europe are mixed at this hour. Britain's FTSE 100 has gained 0.4%. The Paris CAC 40 in France is 0.1% up, while Germany's DAX has shared 0.1%. Looking at commodities, gold is trading at around $2,024 and platinum at $901 per ounce, while the price of Brent crude oil is trading at around $78 per barrel. And a quick look at our currencies, the rand is trading at 18.98 to the dollar, 23.79 to pound sterling, and 20.36 to the euro. Martin Smith is a portfolio manager at Anchor Capital, and he joins me now. Very good afternoon to you, Martin. Thanks very much for joining us. So is the US stock rally party now over, given that the market has been declining, and we're seeing that globally as well today? Of course, there are exceptions here and there, especially as the realization has dawned that interest rates are likely to stay higher for longer.
And especially on the back of what the Fed has kind of come out with in recent days, it's definitely turned a bit more hawkish. But I think if we look back over specifically the last maybe 4, 5, 6 months, it's been a very, very volatile ride insofar as what the market has expected from an interest rate cutting perspective. If you look back at the beginning of kind of October, maybe September, they were expecting no cuts. Then you look kind of fast forward a few months, then it was 6 cuts. Now it's kind of back to just a handful. So it's been a very, very volatile ride, and it's very much dependent on what the data says, what the Fed sees and the like. So I wouldn't get too caught up in it. I think it is going to be very much data dependent, and that obviously we can't always predict that with 100% certainty. So I think it will be data dependent, but I also think it'll be quite volatile. I think we'll have a period, I'm sure, in the next few weeks or months where things look like we'll see like 4, 5, 6 cuts throughout the year. So again, I think let's not get too ahead of ourselves and wait and see how we go.
Yeah. So South Africans are not going to be very happy today, as we've heard that fuel prices are going up at midnight tonight. And part of the reason for this, the DMRE says, is because of geopolitics. And they talk about how it's difficult for oil to be flowing around the world. You know, it's creating some constriction in terms of supply. How concerned are you that geopolitics as they stand are going to actually see an increase in crude oil prices, not to mention, you know, the weakness that we've been seeing in the rand as well?
So I think the weakness in the rand is also a very big one, and I'm glad you brought that up. The geopolitics side of it, I think we actually at relatively similar-ish levels to when things started unfolding last year. So it's definitely a factor, but I think the things that you'd maybe look at are playing a bit more of a role now and kind of pushing oil to where it's at the moment is the fact that there's concerns around global growth, specifically around now the hawkish stance from the Fed, as well as supply coming back on board in the US. Both of those things are going to put a kind of dampener on oil prices. So yes, geopolitics can push the oil price out, which will obviously increase the fuel price, but there are other factors at this moment, which I think might be a bit bigger, that are kind of keeping the oil price a bit lower. So I think it's one to keep an eye out for, but I'm not too concerned as things stand that that's going to be a major factor kind of going forward, but it obviously can change.
So, Martin, we're around the corner from the national budget, and the industry is calling for Transnet to get a proper bailout from National Treasury. That call is really growing because, of course, of its strategic significance. How do you think the markets are going to react should National Treasury decide to stump up cash for Transnet, not to mention all the other state-owned enterprises that it's having to support with little revenue coming in?
So, I mean, the government obviously finds itself in a bit of a tricky situation from a debt and financing perspective. I mean, that's obviously quite clear. So it doesn't have a lot of wiggle room when it comes to Transnet. Obviously, the importance is very high. So I think it just depends on how they fund any type of assistance. If it's a straight cash assistance, then I don't think the market will enjoy that too much. But if it's something like what they did previously, where they had government guarantees, then maybe extend that, then I think the market I think that'll be palatable for the markets. Again, given the strategic importance of Transnet. So again, it comes down to, I think, how they fund the help that they'll provide. So if it's an extension of government guarantees, that's probably the most palatable thing the market will look out for.
Yeah. So yesterday, it's one of the issues I didn't get to chat to my market analyst about. MultiChoice, they came out with a statement to say that they had rejected France's Canal Plus's buyout offer, where they were looking to pay up to a 40% premium on the share price of MultiChoice. They say that this is an undervaluation of the company and therefore they're not interested in talking at these levels. Do you think the board, that is the MultiChoice board, is taking chances, or is really MultiChoice quite a gem? What sort of potential do you see in that?
So, I mean, it's interesting because we were always querying what they were going to be doing with the stake that they were acquiring over the last few kind of months and years. Now it's about a 30% stake they have in MultiChoice. So that price came in at 105, and the board of MultiChoice said it's too cheap. And I think from a valuation perspective, it probably is on the cheaper side of things. What's going to be interesting to see now is if they come back with a slightly improved offer, and then what happens from there. So one to keep an eye out for from that perspective. The other thing also maybe to keep in the back of our minds is how the competition authorities see the transaction. Not sure how that'll play out, but that is also something to keep in the back of our minds, and to see if a second offer arrives.
Indeed. Martin, thank you so much for your time and your insights on the markets and company news there. That was Martin Smith. He's a portfolio manager at Anchor Capital.